Training, residency, early career. It's the busiest season of your life, and for most families, that's exactly when investing gets pushed to later. But later shows up faster than you think, and usually with a mortgage, daycare costs, student loans, and a tax bill waiting at the door. If you're feeling like you're supposed to be investing already, but you're barely keeping your head above water, you're not alone. You just haven't been given a simple framework that works in the way the real world works during years when time is tight and every decision feels very high stakes. Today, we're going to fix that. I'm Devin Watts, founder of Fallbrook FI, and I've spent years helping dual income families who are earning well but really feeling disorganized. Could be physicians just like you trying to bring clarity to financial chaos. In today's video, I'm going to walk through a practical evidence-based framework for investing that actually works in the real world. No complicated strategies, no market timing tricks, just the core principles that matter most and that you can actually control. Why evidence-based investing makes sense. Here's something you pretty much already know because it's evidence-based. So evidence-based medicine works. You don't treat patients based on hunches. You rely on peer-reviewed research, clinical trials, data, and your years of experience. The exact same principle applies to investing, yet most people ignore it when it comes to their own money. Evidence-based investing means building your portfolio on strategies backed by decades of academic research, not based on the hot tips from Reddit or your colleagues that swears they could beat the market. The beauty of this approach is that it frees up your time. You don't need to spend hours every week analyzing stock charts or reading market forecasts. Instead, you build a simple, diversified portfolio based on proven principles, rebalance it maybe once a year, and get back to what you do best, practicing medicine and enjoying life outside of work. Let me give you a hypothetical example. Imagine two residents start investing at age 28. The first resident, let's call him Dr. Smith, spends hours every week trying to pick winning stocks, chasing the latest tech trends, and moving money in and out of the market based on financial news that they're reading. The second resident, Dr. Jones, takes about 30 minutes to set up a simple, low-cost portfolio in index funds, automates their contributions, and checks it once a year during annual financial reviews. Fast forward now 30 years, research consistently shows that Dr. Jones' approach wins about 70 to 90% of the time. Why? Because she avoided high fees, didn't let emotions drive her decisions, and stayed invested through markets' ups and downs. This is the power of evidence-based investing. So let's talk about asset allocation. This is one of the main factors and most important decisions you'll make. Here's a fact that surprises many people. Asset allocation drives roughly 90% of your portfolio's long-term performance and risk. And that's according to many different blogs, including this one written by the CFA Institute on their blog. That means how you divide your money between stocks, bonds, and other assets matters far more than which stocks or funds you pick. Think of it this way. Deciding whether to invest 80% in stocks and 20% in bonds versus 40% in stocks and 60% in bonds, that decision has a much bigger impact on your returns and volatility than whether you choose Vanguard's S&P 500 fund or Fidelity's S&P 500 fund. So how should you allocate your investments during training and beyond? The answer depends on three key factors: your career stage, your risk capacity, and your emotional tolerance for the market swings. Let's break each one down. First, career stage. If you're a 28-year-old resident with maybe 30 to 40 years until retirement, you have a lot of time on your side. Markets historically go up. According to this chart, we can see that 70 to 75% of the time, a 12-month period, the markets go up. That means you can afford to weather short-term volatility in exchange for higher long-term growth expectations. A common starting point for early career physicians is something like 100% to 90% in stocks and 0% to 10% in bonds. As you move into your peak earning years and closer to financial independence, you may actually consider gradually shifting toward more conservative allocations, maybe like 70% to 80% stocks. Second, risk capacity. This is different from risk tolerance. Risk capacity asks, based on my financial goal, how much risk do I need to take and do I want to take? For example, if you're saving for a house down payment in 3 years, the capacity for that money in 100% stocks, even if you're comfortable with volatility, is way less. That money needs to be something stable, maybe a high yield savings account, CDs, or short term bonds. On the other hand, if your money isn't going to be touched for 30 years and you're saving for retirement, you could take on much more risk because you have decades to recover from any downturn. And third, emotional tolerance. This is the psychological piece. Can you actually sleep at night when your portfolio drops in a 20% bear market? If seeing your account balance fall by $50,000 causes you to panic sell at the bottom, then a 90% stock allocation probably isn't right for you. And the math just says that's better to have a better allocation that you could stick to in the good times and the bad. Here's a practical framework many physicians use. If you're in residency or fellowship, late 20s, early 30s, consider starting with 90% to 100% stocks, diversified globally, not just in the US, and maybe 0% to 10% in bonds. As you transition to attending physicians, your income jumps. You maintain that aggressive allocation through your 30s and 40s, and then gradually consider dialing that down with the equity or the stock side of the portfolio as you approach your financial independence. Let me share a quick statistic. Over a 10-year period, nearly 89% of managed large cap US stock funds that are actively being managed, they underperform the S&P 500 index. That means about 1 in 10 professionally managed funds with teams of analysts, Bloomberg terminals, and insider access to what's going on the stock market floor, they actually can't beat a simple low-cost index fund. And here's the kicker. The ones that did beat the market in one decade, they often can't repeat that performance in the next. So why do active managers struggle so much? Three main reasons. First, fees. The actively managed equity funds charge north of 0.6% maybe per year, while a broad-based index fund charges around 0.05 to 0.1%. That 0.5% difference might not sound like much, but over a 30-year period, that compounds. And second, trading costs. Active managers buy and sell frequently, generating a lot of transaction costs and tax bills that eat away into returns. Third, behavioral mistakes. Even professional investors fall prey to overconfidence or recency bias or even herd mentality. They chase last year's hot sectors and potentially dump assets that are temporarily out of favor, and then oftentimes selling at the worst possible times. Passive index investing avoids all of these pitfalls. When you buy a total stock market index fund, you're essentially saying, I'm going to own every slice of the publicly traded companies that are available proportionate to the market value, and I'm going to hold them long term. You're not trying to outsmart the market, you're capturing the market's returns at minimal cost. And here's the beautiful part. Because markets have trended upward and over time, simply capturing the market return is enough to build significant wealth. For a busy physician, passive investing is also a huge time saver. You don't need to do a lot of research on individual stocks, read earnings reports, or stress about whether Apple or Nvidia is overvalued. You could just build a simple portfolio, maybe a total US stock fund, a total international stock fund, and a total bond fund. Rebalance once a year and move on with your life. That's it. This approach has been advocated by legendary investors like Jack Bogle, who's the founder of Vanguard, and also Warren Buffett, who you've probably heard of. Warren Buffett specifically repeatedly recommends low-cost index funds for most investors. Let's say you started the year with a portfolio that was targeting 70% stocks and 30% bonds. Stocks have a great year and surged by 20%, while bonds had a return of 2%. They did their job. But the year ends and your portfolio has drifted now to 80% stocks and 20% bonds. What should you do? Many investors let it ride, thinking stocks are doing great why would I sell these winners? But this is a mistake. By letting your allocation drift, you're inadvertently taking more risk than you intended when you set up your portfolio. Rebalancing means you're periodically bringing back your portfolio back into target with the allocation that you have set up for yourself. In this hypothetical scenario that we just talked about, you'd sell some stocks and buy bonds. Even if you're contributing money, that might actually mean you're just putting all of your money into bonds to bring you back into alignment of your target of 70-30. This forces you to do the hardest thing with investing. It's selling high and buying low. When stocks are on a tear and they're soaring higher, everyone is euphoric. It's natural. You're trimming the gains with this rebalancing strategy. And so when stocks crash and everyone is panicking, you're buying more stocks because you're probably selling bonds, or you're putting more into stocks because stocks are lower. It's contrarian. It's disciplined and it's highly effective. So how often should you rebalance? Research suggests that annual or semi-annual rebalance combined with tolerance bands of maybe 3 to 5% strikes the best balance towards controlling risk over time and minimizing transaction costs. For example, your target going back to the 70% stocks, 30% bonds. You might only rebalance when your stock allocation hits 75% or drops below 67%. This approach helps you avoid unnecessary trading while keeping your risk tolerance in check. Here's a pro tip for physicians. You can use regular contributions to rebalance without selling anything. Let's say you contribute $2,000 per month to your investment accounts. Instead of splitting the 70-30 into your targets, 70% stocks, 30% bonds, you could direct 100% of your new contributions to whichever asset class is underweight. This way, you're gradually nudging your portfolio back towards the target without triggering taxable sales in brokerage accounts. Over time, this strategy can save you thousands in taxes. A common question I get from residents and fellows is, I just got this $20,000 sign-on bonus, or I just inherited this money. Should I invest it all at once or spread it out over several months? And I truly think it's a great question. And the research behind this and how I'm going to answer this, it's pretty clear. Lump sum investing, meaning putting all of the money in immediately, it outperforms dollar cost averaging by about 60 to 70% of the time. Why? Because markets go up more often than they go down. And if you're sitting on cash waiting for the right time to invest, you're missing out on potential gains. That said, though, dollar cost averaging has one big advantage. It's emotionally easier for a lot of investors. If you invest $20,000 on a Monday and the market drops 10% on Tuesday, you may feel really terrible about that. If instead you invest $4,000 per month for 5 months and the market drops, you'll feel less regret because you hadn't deployed all your cash yet and you purchased at different price points. Here's my practical recommendation. If you're a rational, data-driven person who can handle short-term volatility, invest the lump sum. If you're newer to investing, or you know you'll lose sleep if you watch your account balance fluctuate, then spread the investment out over 3 to 6 months. Either way, the most important thing that you focus on is investing this money. The worst strategy is truly to just let that money sit in cash in your checking account earning 0% while you waited for that perfect moment. That never comes. For regular contributions from your paycheck, the answer is simple. You just automate it. Set up automatic transfers for every paycheck to go into your 401k, that's usually through payroll, or with your IRA or your brokerage account. This is true dollar cost averaging. You're investing a fixed amount on a regular schedule regardless of market conditions. Over decades, this smooth, consistent approach builds wealth without requiring any timing decisions. Let's be honest, many physicians don't have the time or interest to manage their own investments. You spent a decade in school, medical training, and then becoming an expert in your field. Do you really want to spend your free time becoming an expert in tax loss harvesting, backdoor Roth conversions, and asset allocation strategies? For some of you, the answer is yes. You're intellectually curious with this stuff. You enjoy financial topics, and managing your portfolio is actually kind of fun. If that's you, that's great. Keep doing it yourself. There are excellent low-cost resources like Bogleheads, White Coat Investor, and even robo-advisors like Betterment that can support your DIY approach. But for many physicians, especially dual income families with young kids, delegating financial planning makes sense. Here's what to look for in a financial advisor. First, fiduciary and fee-only compensation. That means the advisor is getting paid by you, not by commissions from selling products. And they are, because they're fiduciary, required to act in your best interest. You should avoid advisors who earn commissions on investments they recommend. That's really a massive conflict of interest. Second, experience with physicians is a must. Doctors face unique financial challenges: high student loan balances, delayed earnings, insurance protection, and often significant tax burdens. An advisor who specializes in working with physicians will understand these nuances. Third, comprehensive planning. The best advisors don't just manage your investments, they help you with tax strategy, insurance, retirement planning, and investments. This integrated approach that advisors deploy with you is where you get the most value. So, what should you be aware of? Beware of the advisor who promises to beat the market or uses vague language like proprietary strategies. Be aware of high fees. Anything above 1% annually for investment management is pretty hard to justify. Not saying it's impossible though. And be aware of advisors who make you feel dumb or talk over your head. Truly, a great advisor explains complex concepts in plain English for you and empowers you to make informed decisions with your finances. Look, investing doesn't have to be complicated. Allocate wisely based on your career stage and goals. Use low-cost index funds to capture market rates of return. Rebalance once or twice a year to maintain your risk level. Invest automatically and consistently. Stay the course through the market's ups and downs. Your advantage as a physician and a high-income earner is you now have this evidence-based mindset. High future income is a plus, and you have a long time horizon. These are already built into your situation. Now, it's time to put it to work. Let me know in the comments what questions you may have as you go through this process of learning how to invest for your future. Also, if you're a dual income young family earning well but feeling disorganized, this is your moment to bring clarity to your finances. Reach out to Fallbrook FI for more practical, no fluff guidance designed to help families like yours build wealth with confidence. Thanks for watching.